You check your portfolio. Again. It's the fourth time today. The market moved less than 1%, but somehow your heart did. You tell yourself you're making rational decisions. You're looking at numbers, charts, percentages. But here's the strange truth. The biggest force controlling your investments isn't the market. It's a brain that evolved over 200,000 years ago, long before money, stocks, or even civilization existed. Imagine two people. Both invest $10,000. They buy the same index fund. Everything is identical. Then, 6 months later, the market crashes. 40% disappears. One investor panics. They sell everything. "I'll buy back when things feel safer," they tell themselves. The other investor feels the same fear, the same knot in their stomach, the same temptation to run. But instead, they buy even more. 10 years later, one barely made any money. The other quietly built financial freedom. The difference wasn't intelligence. It wasn't education. It wasn't luck. It was psychology. Because your brain was never designed for investing. It was designed for survival. For hundreds of thousands of years, reacting quickly kept our ancestors alive. A sudden movement in the bushes? Run first. Think later. If you waited for evidence, you might become lunch. That instinct was brilliant on the African savanna. It's terrible in the stock market. Because when prices fall, your brain reacts as if you're facing a predator. Your heart races, your palms sweat. Every instinct tells you, get out. Psychologists Daniel Kahneman and Amos Tversky discovered why. They found that our brains don't experience gains and losses equally. Losing $100 feels roughly twice as painful as gaining $100 feels good. This is known as loss aversion. Your brain treats losses like emergencies. So when your portfolio drops 20%, your logical mind may understand that markets recover over time, but your emotional brain isn't thinking about the next 10 years. It's trying to stop the pain right now. And that's exactly why so many investors sell right before the market begins recovering. But loss aversion isn't the only trap. Imagine opening your phone. Every headline says the same thing. Markets are collapsing. Investors are panicking. Experts warn of worse to come. Your friends are selling. Social media is filled with fear. Suddenly, doing nothing feels irresponsible. This is herd mentality. For most of human history, following the group kept us alive. If everyone ran, there was probably a reason. But in stock markets, the crowd is often driven by fear instead of facts. People rush to buy when prices are already high because everyone else is making money. Then they rush to sell after prices have already crashed because everyone else is afraid. In ironic turn of events, the crowd often buys near the top and sells near the bottom. The market hasn't changed. Human nature has. Researchers later analyzed the trading records of thousands of ordinary investors. They expected the mistakes to be random. Instead, they found the exact same pattern over and over again. People sold their winning investments too early. They held on to losing investments far too long. Not because they lacked information, not because they weren't smart, because admitting I was wrong hurts, sometimes more than losing money itself. Psychologists call this the disposition effect. Selling a losing investment forces your brain to admit a mistake. So instead, people wait and hope. Not because hope is a strategy, but because hope feels less painful than acceptance. The investment isn't protecting their money anymore. It's protecting their ego. Then there's another psychological trap, one that's much quieter: overconfidence. Many people believe successful investors constantly react to the market, watching every headline, checking every chart, making quick decisions. But research tells a very different story. A landmark study by Brad Barber and Terrence O'Dean found that investors who traded more frequently actually earned lower returns. Why? Because confidence often creates unnecessary action. Every trade feels productive, every prediction feels intelligent, but every extra decision creates another opportunity for emotion to interfere. Ironically, Doing less often leads to better results. Think about how strange that sounds. Modern life rewards speed, respond faster, work harder, react immediately. The stock market rewards almost opposite: patience, distance, silence. Another invisible trap is recency bias. Our brains naturally assume that whatever happened recently will continue. If markets have been rising for months, we expect they'll keep rising forever. If markets have been falling, we assume they'll never recover. But history tells a different story. Markets move in cycles. Fear passes, optimism returns. Yet our brains struggle to believe that while we're living through it. Successful investors understand something most people don't. The market isn't testing intelligence, it's testing emotional control. Even Warren Buffett has said that investing requires temperament more than brilliance. Modern psychology agrees. The greatest investors aren't fearless, they simply refuse to let fear make their decisions. So how do they do it? Many of them make important decisions before emotions arrive. They create rules. Rules like, I'll continue investing every month no matter what the headlines say. I'll only sell if the original reason for buying has changed. I won't check my portfolio every hour. Psychologists call this pre-commitment. You make decisions while calm, so your frightened future self doesn't have to. Athletes use it, pilots use it, surgeons use it, and successful investors do too. Because willpower is unreliable, systems aren't. Over time, something remarkable happens. Every market crash you survive without panicking becomes evidence. Evidence that fear doesn't always deserve obedience. Every emotional decision you resist strengthens a different habit. Not confidence that markets will always go up, confidence that you can stay calm when they don't. And perhaps that's the biggest lesson of all. The stock market isn't really a competition against other investors, it's a competition against yourself. Every crash exposes fear, every boom exposes greed. Every investment asks the same question: who's making this decision? Your future self, or a brain that still thinks it's hiding from lions? Because the investors who build lasting wealth aren't necessarily the smartest, they aren't the luckiest, they aren't the ones who predict the future. They're the ones who understand something far more valuable. The greatest investment you'll ever make is learning how your own mind works. Because once you stop fighting the market and start understanding yourself, everything changes.